Every empire thinks its money is different. Every central bank believes it has learned from the last crisis. And every time, history proves them wrong. For over 3 centuries, the British pound sterling has stood as a symbol of stability, empire, and financial power. It was once so trusted that people described it as good as gold. Yet again and again, the Bank of England has been forced into humiliating retreats. Emergency meetings, late-night phone calls, interest rate shocks, pleas for foreign help, and carefully worded statements that arrive just a little too late. Each time, the question in the room is brutally simple. How do we stop this from collapsing today? Behind those closed doors, there is no magic. There are only hard trade-offs, political pressure, and the limits of what even a historic central bank can control. The public hears phrases like temporary volatility, market overreaction, and restoring confidence. But the deeper story is a pattern of crises where sterling is pushed to breaking point, defended to the last minute, and then suddenly sacrificed in the name of survival. From 1931 to 1949, 1967, 1976, 1992, and the bond and currency turmoil of recent years, the pound has been through repeated episodes that were each sold as a one-time mistake, a unique shock, a lesson learned. Yet, taken together, they reveal something much more uncomfortable. Sterling crises are not random accidents. They are moments when reality catches up with years of imbalance, denial, and wishful thinking. On paper, the Bank of England is one of the most powerful institutions on the planet. It sets interest rates, it helps oversee the banking system, it supports the government's enormous debt market. For much of modern history, it has also guarded the value of the pound, trying to keep British money stable, trusted, and strong in the eyes of the world. The mythology says sterling has been a pillar of reliability. History says something else. For much of the last century, the pound has looked less like an unshakable rock and more like a patient that regularly turns up in the emergency ward, feverish, unstable, and needing high-risk treatment to avoid a full collapse. The Bank of England has been forced to choose again and again between defending an idea of strength and accepting the pain of admitting weakness. The truth behind those moments is simple and brutal. The institution learns lessons from each crisis. The public pays the bill for those lessons through lost jobs, higher prices, weaker savings, and quieter forms of financial stress that never make the headline statements. To understand why sterling keeps ending up in these positions, it helps to go back to the period when the pound really did look untouchable, at least on the surface. A time when as good as gold was not just a phrase, but a literal promise. In the 19th and early 20th centuries, the British pound sat at the center of global trade and finance. London was the world's banker. The British Empire stretched across continents, and its money was anchored to a simple, rigid rule. Under the classical gold standard, a pound meant a specific amount of gold. That was the deal. The Bank of England's mission was clear: defend that link at almost any cost. If gold started flowing out of the country because Britain imported more than it exported, or because investors moved capital elsewhere, the bank reacted with a well-known toolkit. Interest rates were raised sharply to lure money back. Credit conditions were tightened. Domestic borrowing became more painful. The economy was squeezed so the exchange rate could be saved. In that world, the currency came first. Businesses, workers, and households came second. This was seen not as cruelty, but as discipline. A strong currency fixed to gold was a badge of honor. Politicians and central bankers believed that sticking to that promise proved seriousness, responsibility, and strength. Devaluation, abandoning the peg, or admitting the currency was overvalued were seen as national humiliation. Hidden inside that proud system was a trap. When markets and the real economy moved in one direction and the chosen exchange rate pointed in another, there were only 2 options: sacrifice people or sacrifice the illusion. Pain at home or a fall in prestige abroad. Eventually, the arithmetic forced a choice. By the early 1930s, that choice arrived. The world was in depression. Unemployment in Britain was painfully high. Banks were under strain. International investors doubted whether the country could really maintain the old pre-war gold parity for the pound. They began selling sterling and asking for gold instead. Gold reserves drained away. Confidence weakened further. A vicious loop took hold. Officials insisted everything was under control. Interest rates were held high even as the economy struggled. Emergency credit lines were arranged. Statements were issued to reassure markets. None of it stopped the flow. The numbers did not care about the speeches. By September 1931, the pressure was unbearable. Britain abandoned the gold standard. The pound was allowed to float, and it quickly fell in value against other currencies. To many observers at the time, this looked like a national disgrace, the end of an era of monetary virtue. From a wider historical view, it was something else. The moment when the country finally chose its own economy over a rigid rule written for a different world. The lesson was harsh and simple. An overvalued currency cannot be defended forever. Reality will win. The longer that reality is denied, the greater the damage when the break finally comes. Higher unemployment, deeper recessions, longer periods of stagnation. Those were the costs of clinging to the gold illusion for too long. That pattern of delay, denial, and then sudden surrender did not end with 1931. It reappeared after the Second World War, in a different form but with a familiar flavor. Britain emerged from the war victorious, but heavily weakened. The empire was fraying. The economy was exhausted. The debt was enormous. Yet the desire to act like a top-tier power with a strong, respected currency remained. The pound still carried prestige, but the real backing behind it was thinner than the story suggested. In 1949, under pressure from trade imbalances and limited reserves, the government cut the pound's value against the dollar in one sharp move. Overnight, sterling officially became worth much less in foreign terms. It was a controlled humiliation. Better to devalue once than to bleed slowly. For ordinary people, it meant imported goods became more expensive and the illusion of post-war strength looked more fragile. Then, in 1967, it happened again. Long-standing trade deficits, weak growth, and external pressures forced another devaluation. The Prime Minister at the time tried to soothe public fears by insisting this did not mean the pound in your pocket had been devalued. Technically, wages and prices at home did not change that instant. But over time, a weaker currency abroad feeds into higher prices at home. The gap between political reassurance and lived reality was obvious. These episodes taught another hard truth. Words cannot cancel arithmetic. Politicians can attempt clever phrases, but if a currency is consistently priced above what the economy can sustain, gravity eventually wins. Confidence erodes quietly for years and then collapses suddenly in a single announcement. Each devaluation damaged more than just the exchange rate. It weakened trust in the institutions managing the currency. If the pound can be cut down overnight, what does stability really mean? How much of today's value is permanent and how much is just temporary confidence? By the mid-1970s, a different kind of humiliation appeared. Not a formal devaluation and not a broken gold promise, but something arguably more symbolic. The United Kingdom asking the International Monetary Fund for help. The 1970s were a decade of stagflation, high inflation, sluggish growth, and repeated shocks like the oil price spikes. The pound came under intense pressure as investors worried about inflation, deficits, and the government's grip on policy. Sterling fell. Capital left. The Bank of England struggled to stem the tide. Eventually, the government turned to the IMF for a large loan. The money came with conditions: spending cuts, tighter policy, and an implicit admission that domestic control over the situation had weakened. For a country that once dominated global finance, this was more than a funding arrangement. It was a message. Credibility had been stretched too far, and now outside referees were involved. But the underlying lesson was clear. A central bank and a government cannot run loose policy, high inflation, and a weak currency indefinitely while expecting markets to nod along. At some point, trust runs out. When that happens, financial independence shrinks. Decisions are no longer made entirely on domestic terms. Even that was not the last time sterling policy collided with reality. The stage shifted again in the early 1990s, when the pound was bound inside a European system that tried to fix currency movements within tight bands. Britain's membership in the European exchange rate mechanism was supposed to deliver stability. Each currency in the system could only move within a narrow range against the others. If it drifted near the edge of that band, the central bank would step in, raise interest rates, and buy its own currency to push it back. The story was one of discipline and European cooperation. But the pound's assigned value inside the ERM was too high for the state of the British economy. Growth was weak. Unemployment was elevated. Defending the ERM parity required painfully high interest rates, which hit homeowners and businesses hard. The mismatch between the political promise and economic reality turned the pound into a target. Speculators noticed. They saw an overvalued currency, a government terrified of losing face in Europe, and a central bank forced to defend a level that markets did not believe in. Selling sterling and betting on devaluation became a rational trade. On Black Wednesday in September 1992, the Bank of England launched a desperate defense. Interest rates were raised dramatically in a single day. Billions were spent on buying sterling. And yet the market did not blink. Traders kept selling. Confidence was gone. By the end of the day, Britain abandoned the ERM. The pound was allowed to fall. Those who had bet against sterling made enormous profits. The Bank of England and the government were left with damaged credibility and a vivid reminder that even a historic institution cannot overpower a market that sees a clear mispricing. The deeper message was simple. Credibility is not just about determination or how loudly officials insist they will do whatever it takes. It depends on whether the story being defended matches the underlying fundamentals. If the exchange rate being protected is out of line with the real economy, every promise to defend it simply invites larger bets against it. After that, the next phase of Sterling's story involved fewer dramatic one-day breakdowns and more slow-burn distortions. The toolset changed. The core fragilities did not. Following the global financial crisis in 2008, the Bank of England joined other central banks in pushing interest rates down to levels that would once have seemed unthinkable. It began large-scale asset purchases, quantitative easing, creating money to buy government bonds and other securities. The immediate goal was to stabilize the financial system, prevent a depression, and support borrowing. In the short term, the strategy worked. Banks survived, markets calmed. Borrowing costs stayed low for governments and companies. But low rates and constant central bank support came with side effects that did not show up overnight in official inflation statistics. Asset prices surged, housing became more expensive, stocks climbed, bonds were bid up, debt accumulated at cheap rates. Savers saw returns vanish. Pension funds searched for yield and sometimes turned to complex, leveraged strategies tied to the bond market. The appearance of stability masked a growing sensitivity to any future rise in rates or drop in confidence. At the same time, broader political shocks were shaking assumptions about Britain's place in the world. The Brexit referendum reopened questions about trade, investment, and long-term economic direction. The pound fell after the vote, a reminder that currencies are not just math, but also stories about a country's future. For a while, ultra-low rates and central bank support kept this new world glued together. Then, inflation returned with force after the pandemic. Energy prices jumped. Supply chains strained. Years of cheap money met a sudden need for higher interest rates to control rising prices. The comfortable assumption that borrowing could stay nearly free forever evaporated. In 2022, those stresses converged around UK government bonds and the pound. A mini-budget that promised large, unfunded tax cuts landed in a world no longer willing to ignore deficits and rising debt. Markets responded quickly. Investors sold gilts heavily. Prices plunged, yields spiked, and the pound dropped sharply against the dollar, briefly flirting with levels once considered unthinkable. The shock did not stop at the currency. Pension funds that had piled into leveraged strategies linked to long-term bonds suddenly faced massive margin calls as bond prices fell. The plumbing of the financial system began to creak. Within days, the Bank of England had to step in and buy bonds urgently to prevent a full-scale meltdown, even while inflation was still a major concern. The government rapidly reversed much of its plan. Political careers were cut short. It was another clear message. Markets still judge stories. Age, prestige, and historical importance of a central bank do not exempt it from reality. A narrative that ignores arithmetic, debt dynamics, and global conditions will be rewritten by investors, often with astonishing speed. Across all these episodes, certain lessons stand out. First, narrative cannot permanently override reality. Officials can describe a currency as strong, talk about stability, or accuse markets of overreacting. But if a currency is mispriced, if policy is inconsistent, or if debt and deficits reach levels that scare investors, speeches do not fix the problem. At best, they buy a little time. Second, defending symbols can destroy substance. The gold parity in 1931, the post-war exchange rates, the ERM band in 1992, the appearance of fiscal boldness in 2022, these all involve defending an image of strength that did not match the underlying conditions. Clinging to those symbols for too long increased the eventual damage. The longer the delay in adjusting, the sharper the adjustment when it finally came. Third, crises do not erase wealth so much as move it. When sterling is devalued, when inflation erodes purchasing power, when bond markets swing violently, someone is on the wrong side of the trade and someone is on the right side. Savers in the domestic currency, workers paid in money that buys less, and pension funds locked into fragile structures tend to lose. Holders of real assets, foreign currency, or more flexible positions often gain. Each crisis becomes a transfer, from those who trusted the official story to those who prepared for its failure. Finally, the past may not repeat in identical form, but its rhymes are loud. The details differ. Gold pegs, fixed exchange systems, IMF loans, quantitative easing, pension fund leverage. But the underlying rhythm is recognizable. Overconfidence, imbalance, denial, shock, adjustment, and then an official claim that the lessons have been learned once and for all. Sterling crises reveal more than just the vulnerability of a famous currency. They show the limits of control in any complex financial system. They expose the gap between what institutions want to project and what the numbers ultimately allow. They remind anyone paying attention that no currency, however historic, is invincible. No central bank, however sophisticated, is all-powerful. And no promise about stability is stronger than the reality underneath it. The Bank of England's hard lessons are written in abandoned pegs, sudden devaluations, humiliating loans, speculative attacks, emergency interventions, and the quieter erosion of savings through inflation and policy error. Those lessons sit in archives, speeches, and internal reports. But they also sit in the lived experience of millions of people who watched the value of their money shift under their feet. When the next confident declaration about stability or credibility is broadcast, those memories are worth keeping close. For anyone listening closely, history is not just a distant record. It is a warning label. If this gives you a new way to see the world of money and power, hit subscribe. History already holds the answers. For those who choose to look before the next crisis, writes them in real time.